You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, joining me on today's program is my special guest, Mr. Karl Denninger. Many of you who are longtime listeners to RLA Radio will recognize Karl as the proprietor at market-ticker.org. The website again, market-ticker.org. Karl is a prolific commentator and always appreciate his perspective. He will be joining me again momentarily here on today's program. We'll talk about healthcare. We'll talk about the yield curve flattening. We'll get his take on where housing goes. So you won't want to miss that conversation. If you have not yet requested a complimentary copy of my best-selling book titled Winning Strategies, I would encourage you to do that. All you need to do to get your copy of that book is visit requestyourbook.com. The Winning Strategies book will give you some sage advice about investing and asset management in the current economy. It will share with you a tool titled the Wealth Protection Trust that can make your family financially bulletproof. Also, the book is full of tax-saving strategies as well. So again, to get your copy of that complimentary book, Winning Strategies, just visit requestyourbook.com. Well, as I suggested last week on the program, the Fed did cut interest rates this week. They cut interest rates by a quarter point. The Fed is really in a difficult place. To use an old metaphor, they're really between a rock and a hard place. When you look at inflation reporting of late, it shows that inflation is actually accelerating. Core services, which include essentials like housing, healthcare, and insurance, rose by 4.3% on an annualized basis from July to August. That's the second month in a row that core services rose on an annualized basis of more than 4%. Now, the largest price increase in core services came from used vehicle prices. Food and gasoline prices also jumped. Now, core CPI, which does not include food prices or energy costs, jumped 0.35% month over month from July to August. That translates into an annualized rate of 4.2%. That is the worst level since January. And when food and energy prices are added back into core CPI, the annual inflation level is 4.7%. That's approaching 5%. So those rising inflation numbers really don't suggest that this Fed interest rate cut was warranted. However, there is another issue. We find that jobs created were overreported in the past year by 1 million jobs. 1 million jobs were reported as being created, and now they have been revised downward. That tells us that really, whenever you see a jobs report, until we get a revision months later, you really can't believe what you're hearing. Now, the jobs market did reach a tipping point at the end of August. For the first time since 2021, there are now more unemployed people than there are job openings. So that tells us that perhaps we have reached a tipping point in the jobs market. So the Fed may be looking at that. However, I expect more rate cuts to come in the future. The bottom line is that the Fed really needs to try to cut interest rates to jumpstart this economy, which is not performing well whatsoever. Of course, the other issue relating to interest rates is the rising costs of financing U.S. government debt. As I mentioned recently, according to Wolf Richter, at a recent government bond auction, over $700 billion of U.S. Treasury debt was auctioned off. Over $500 billion was sold with maturities of 4 weeks to 52 weeks. So the other looming problem we have on the horizon here, that it's going to be more difficult for the U.S. government to finance an ever-increasing portion of debt because the government is operating with a $2 trillion operating deficit for as far as the eye can see. That, in my view, makes a debt crisis at some future point inevitable. Note that I did not say a debt crisis is imminent, but it is inevitable. The Kobayashi letter published a statistic last week that is nothing short of mind-boggling. By 2055, that's 30 years from now, U.S. government debt will reach $150 trillion, and that's according to research by the Congressional Budget Office. The CBO is not known for its conservative estimates. That would push the national debt to gross domestic product ratio to about 170%, up from the current level of about 120%. And that assumes that we continue to have economic growth. Now, for perspective, that 170% number is simply mammoth. Over the past 50 years, U.S. government debt to GDP has averaged 69%. So this would be 100% more than the average over the past 50 years. According to Congressional Budget Office estimates, the federal government's operating deficit will exceed 5% of GDP every year for the next 30 years. Of course, the all-important question that brings to mind is, how will the policymakers and politicians attempt to fund this monster funding shortfall? Well, given the problem is too large to solve via increased taxes, given that there doesn't seem to be any political will on either side of the aisle to rein in spending, the only other option is to pursue easy money policies, and we have headed back down that road again this past week. Now, as I've mentioned many times here on this program, this is exactly what has happened historically. And mark my words, it's exactly what will happen again. And if you've not yet taken appropriate steps in your portfolio to potentially profit from more easy money policies, I would encourage you to check it out. And one way to get some more information is to go to requestyourbook.com and get your copy of the Winning Strategies book absolutely free. Now, I did have a listener to the program share an article with me this past week, and the article is really alarming. Seems there is a change coming to the reporting rules that govern how banks report loans that have been modified to help buyers to keep from defaulting, to help borrowers to keep from defaulting. Beginning this fall, U.S. banks will no longer have to disclose the total outstanding amount of loans whose terms have been modified to keep borrowers from falling behind. Up to this point, a loan whose terms have been modified needed to be flagged as such for the life of the loan. This reporting standard has been in place since the 1970s, or for about 50 years. Under the new reporting rules, banks need only to report the loans which have had their terms modified within the past 12 months. After 12 months, this reporting requirement drops off, and we will have no idea as to the total health of a bank's loan portfolio. Now, not surprisingly, the leading advocate for this change was a group called the Bank Policy Institute, which is an official sounding name for a lobbying group that represents large banks. Now, why would many banks advocate for these changes? Well, that question really answers itself. Unless there have been excessive levels of loan modifications that banks want to hide, there would be no reason to push for these changes. That's another reason to think about making changes in your portfolio. That's what I have for you this week. Now let's go to the conversation that I had with Mr. Karl Denninger. Hey, Dennis Tubbergen here. If you have not yet requested your complimentary copy of my best-selling Winning Strategies book, I'd like to invite you to do so. Just visit requestyourbook.com. Let me know where to mail it, and I'll be very glad to do so. The book will give you some sage advice about investing and asset management in the current economy. You learn about the wealth protection trust and how to make your family potentially financially bulletproof. The book is also chock full of tax reduction strategies. It's yours for free. Just visit requestyourbook.com. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Karl Denninger. You can check out Karl's work at market-ticker.org. I do frequently to encourage you to do the same. And Karl, welcome back to the program.
Thank you very much for having me.
So, Karl, let's just jump in and talk about the U.S. economy. Trump says it's the hottest economy going. The numbers don't seem to maybe back that up. What say you?
The most recent employment data on a non-adjusted monthly basis says we lost about 500,000 jobs. Now, that is, of course, not what was announced. Big shock, right? But that's the data. And the bigger problem is that since December of 23, so this is, of course, before the election, the 12-month run rate for job growth, working age population growth, has been on a negative slope and is now sitting at about negative 3 million. That indicator does bounce around some, but when it is on a consistent negative slope for more than 12 months, it has historically only happened twice, and both of them, well, at least in the last 35 or 40 years that I've been tracking it anyway, and both of those times were in front of extremely serious economic dislocations, specifically 2000 and 2008. It has never given a false signal in all of the time that I've been tracking it. Now, the problem is it doesn't give you a timing signal, because it can be that way for 15 months. It can be that way for 2 years. But it has never reversed and gone back into a reasonably stable sort of condition without there being some kind of a dislocation. So that warnings, that red flag has been up now for about 8 months, and it continues today, and it's not getting any better. So there's that. The other thing that's kind of interesting about the internals is that if you look at the usually what you see before people start getting fired in size is that hours get cut, because employers will take hours first from people before they'll lay them off. Just like when things are expanding, it's the other way around. Employers will add time before they add people, because it's easier, faster, and cheaper. So the interesting thing is that I'm not seeing much in the way of a delta in hours worked, either in overtime or in the general hours worked. They're just this month was unchanged for all intents and purposes across across both services and goods. It's a little bit down in goods, a little but not enough to really matter. And of course, services is 70% of the economy, but it was good side was only down one tick, so that it wasn't enough to actually hit the overall number. And that also was reflected in the hourly paychecks, the actual hourly weekly paychecks. There was no notable decline in weekly paychecks. So if you had hours getting cut in certain areas of the economy, you might see the wage per hour go up, but the weekly paycheck goes down because people are getting fewer hours, and that's not happening. So the internals all match up. It doesn't look like there's anybody twisting any knobs. But what it says is that in general, there just isn't a whole lot here. Right? I mean, I guess that's the best way to put it, is there's no there. But I certainly don't see an economy that is weakening from a labor market point of view.
So, Karl, when you look at where the stock market is, we've got the S&P 500 making new all-time highs. The Dow also confirmed by making new all-time highs. Given what you just said about the economy, do you have a forecast for the stock market?
Yeah, I think we got a lot of trouble coming. The what you basically have is a leverage driven market that is trading at valuation levels and at margin debt levels that have never been seen before. And that ought to be, if this is the start of some new boom cycle, if you will, that should be coupled with extremely strong and improving labor and other credit indications, and we're not seeing that. So that means we should see, the coverage ratios, wages versus debt levels and things like this should be improving. Okay, so your amount of money you make versus the amount that you have outstanding in consumer loans and such, that ratio should be getting better. It's not, it's getting worse. And you don't see expansion in the labor market. You don't see contraction, but you don't see expansion. What you see is expansion in multiples. And it's not just in price earnings, it's in sales. And that's the concentration risk when you see things like NVIDIA come out and report, issue a quarterly report, and something like 40% of their sales are to two customers. I can't get my arms around how anybody thinks that's the kind of thing that you consider a good investment. I think that's crazy. What happens if one of those guys all of a sudden says, "Oh, by the way, all those AI chips we're buying, we're not making any money on them. We're going to stop buying them."
Right. So, Karl, the Fed appears to be poised to reduce interest rates, which I think, given debt levels and deficit levels, is entirely predictable. What do you think happens ultimately with Fed policy? And do you see us, due to all the debt and deficits, do you see us going back to a time where QE is the only option?
No, because I don't think it works anymore. And if you look at the market, historically speaking, the market always leads the Fed. And the market is currently saying that there's going to be 25 basis points come off at the next meeting. Okay, I mean, that's what the IRX is telling you. The thing that I don't understand is that over the last week, in particular of time, and of course, there's a delay between recording this and when people hear it, so this could change. But over the last week, there's been a lot of flattening in the curve, which certainly implies that people believe the economy is getting weaker, and therefore the Fed is going to come in and do something. The problem with this is you cannot solve a fundamental affordability problem by cheapening the cost of credit. That doesn't work. And furthermore, the places where it is most evident are in housing, to be specific. I mean, that's the first place where it is. Taking 25 basis points off rates or even 50 basis points off rates is not going to change that. You have the median home price in areas such as mine pushing $400,000, and your median income is 70 grand. That I don't care how far you lower rates, that's not going to make the house affordable. Okay, you'd have to double people's incomes, and that's clearly not going to happen. So I think the Fed's in a tough spot here. I do believe that they'll, like I said, I'm just looking at the IRX. I'm not saying what they should do. My opinion is that the only way you're going to get the Congress to stop spending like drunken sailors is for rates to go up. The problem for the Fed is if they cut the short end of the curve and the market discerns that there is going to be no fiscal rectitude of any kind from either side of the aisle, then there is a very real possibility that the long end reacts by going higher. And if that occurs, then the Fed's lost control of the game. And that kind of thing has happened before. It can happen again. And if it does, it's going to be pretty ugly.
Well, Karl, you mentioned housing, and I think I saw this past week that the Case-Shiller housing index, both the top 10 metro areas and the overall index, down 4 months in a row. Seems like that's a trend, not an aberration. Is the top end in real estate here in your view?
I think the top is past. Certainly around here it has. But in this local area, there's really two markets. There's the short-term rental market, and then there's the market for people that actually want to live in the place. And if you were trying to catch the top and sell, you're at least 6 months late on both of those. And on the short-term rental market, you're probably 12 months late. So, and on the short-term rental market, I'm already starting to see the foreclosures show up. So the cash flow problems are starting to show up in people that bought those with leverage in the last few years. Now, there's an awful lot of people that during the crazy 1031 out of places like California into places like where I live because we were open and they were closed. And they essentially, it's a regulatory arbitrage play. Those folks, if they didn't have any leverage on in the first place, and those were cash transactions, yeah, okay, their net present value goes down, but but they're not going to end up in foreclosure because there's nothing to foreclose. There's no loan. But the people that came in here and thought they were going to become, multimillionaires buying rental cabins at rental rates and fill, occupancy rates that were absolutely unsustainable. Oh boy, are they in trouble. And the same kind of thing has happened with the way that prices got run up. If you came here from New York or somewhere like that, and you did a cash exchange, you sold your house in New York and you bought one down here, and it was a cash transaction. Um, if you bought it for 5 and it's now 3.5, 4, you might swear, but you got the 5 and you shouldn't have gotten it in New York either. If when you make lateral moves in the market like that, you really don't gain or lose anything when there's a bubble going on because you paid too much and you got too much. Um, but the person who is trying to come into the market late in the game, especially younger people, there's a lot of pain coming, and that's where I think the biggest problem is going to come from is in the younger cohort that has entered the housing market in the last 5 years.
Well, my guest today is Mr. Karl Denninger. His website is market-ticker.org. The website again, market-ticker.org. I'd encourage you to check it out. And I'll continue my conversation with Karl when RLA Radio returns. Stay with us. Hey, Dennis Tubbergen here. If you have not yet requested your complimentary copy of my best-selling Winning Strategies book, I'd like to invite you to do so. Just visit requestyourbook.com. Let me know where to mail it, and I'll be very glad to do so. The book will give you some sage advice about investing and asset management in the current economy. You'll learn about the Wealth Protection Trust and how to make your family potentially financially bulletproof. The book is also chock full of tax reduction strategies. It's yours for free. Just visit requestyourbook.com. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I'm chatting today with returning guest, Mr. Karl Denninger. If you're not familiar with Karl's work at market-ticker.org, I'd encourage you to check it out. Karl is a prolific commentator. I follow his work. I encourage you to do the same. Again, the website, market-ticker.org. So, Karl, in the past, we have talked a bit about some of the inherent problems with the healthcare system, and maybe for context, we should talk a little bit about some of the issues with pharmaceuticals and what's charged overseas, what's charged in the U.S., and maybe just for a springboard, we could maybe revisit briefly what we've talked about in the past. And we'll talk about the fireworks that happened recently here when RFK was in front of Congress.
Yeah, well, the basic situation that you have here is that there's a body of law called 15 United States Code Chapter 1, which is the antitrust statutes. And that series of laws, Sherman, Clayton, Robinson, Patman are the 3 primary components, and there's a bunch of little ones. Those all date back to the early 1900s, and they came out of the Standard Oil fiasco and stuff like that. So they essentially state that a discriminatory and monopolistic price fixing scheme is illegal. It's illegal, and that's what Sherman says. Clayton says it's illegal if you try it and fail, and that's because there were several people who were prosecuted under the original statute who said, well, we tried to do it, but it didn't work. So Congress, that was their excuse for why they shouldn't be locked up and fined. And so Congress said, "Oh, by the way, trying it is illegal now too." So yeah, you don't actually have to succeed. You know, it's kind of like well, I tried to rob the bank, but I didn't actually get any money. And they said, "No, no, 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 no." Um, so then and then you have Robinson Patman that says that when it comes to goods, which of course drugs are goods, so are medical components, syringes, IV bags, whatever. When it comes to goods, anything that's transacted in interstate commerce, if you discriminate in price between buyers of like kind and quantity, that's against the law. So you can give somebody a discount because they ordered 1,000 or something instead of five. What you can't do is charge one guy that buys five one price and another guy that buys five a different price when they both are paying on the same terms. Okay, it's just illegal. This, by the way, is one of the reasons that you have price stickers on the shelf in Walmart and the prices displayed for gallons of gasoline at the pump and things like this. So these laws have been around for 100 years. The health companies and the health insurance companies in particular challenged these, and these two cases that went to the Supreme Court in the late 1970s and early 80s when they were decided. One was called Royal Drug, the other one was Maricopa County. They lost both times. The Supreme Court came back and said, nope, sorry, you do not have an exemption because you have an insurance interest or you're a consortium of physicians or whatever have you. Nope. The law is very clear. The text is clear. You lose, you're liable under these statutes. Well, nobody's gone to jail since then. And neither Republican or Democrat administrations or Justice Departments have done a thing about it. So we live in a world today where you pay 5 times as much on average, and sometimes 10 or 20 times as much as you do in other first world countries when you're in the United States. And how much you pay for something depends on who you bought your so-called insurance from. Now, you'd never put up with that in a gas station. If there was no price posted on the pump and you didn't know how much you paid for your gas until after you told them, you pumped it first, so now you got to pay because you got it. And then, oh, by the way, who's your car insurance company? Okay. Nobody would stand for that, but that's what we do. And that's the world we live in today. And so that's part of the corruption that goes on. But what happened with RFK in this hearing was really stunning because when you have this kind of a situation, it creeps into every aspect of the business. It's not just in one place, it's everywhere because you have to build this entire bureaucracy and layers of billing systems and things like this in order to figure out who you're going to screw out of how much. Okay. I mean, because everybody's different, right? The easiest price is, of course, well, it's $1.20 a pill or it's, $20 or whatever it is. Well, if you've got to have all this other stuff, now everything gets complicated instead of very simple. And the senators were basically grilling RFK because he has made some statements that he is not convinced that the COVID shots were either safe or that they actually did anything, and he's got receipts that appear to show that in fact he's not lying, he's not making it up. This is what the data actually says. But they were after that. They were also after the fact that there was a measles outbreak in Texas earlier this year. Which, by the way, probably came from some of the undocumented people that are in this country. Because, gee, that wouldn't be right next to the Mexican border, would it? I don't think so, but, maybe it was. Of course, exactly. They never did trace patient zero, how it got into the U.S., so we don't know. But there was that, and they were very upset with him about the way he dealt with that. And one of the points he made was, okay, so first off, he starts listing off names of senators who are attacking him and saying, oh, by the way, you took $2 million worth of campaign contributions from the pharmaceutical industry. You took $800,000. You took 700. He's going down the list. Gee, why are you so interested in protecting their revenue streams if they're selling drugs that don't work? That's a shock, right? And then he went even further. And this had my hair on fire because he one of the senators came after him and said, "Well, you have made a statement that the CDC is the most corrupt organization in the in the government." And he said, "Well, no, that's not quite what I said." He says, "Well, you said something like," he says, "Well, actually, what I said was that it's the most corrupt organization under Health and Human Services, which of course is the department that he's in charge of." And he says, "By the way, I stand by that. And yeah, I made that statement. I meant it." And he says, "Well, what are you talking about?" And he says, "Well, I'll give you one example. In 2002, there was a study that the CDC commissioned where they had black males, black children, boys, half of whom got the measles vaccine on the recommended CDC schedule. The other half got the vaccine, but they took it later. So they didn't do it on the published schedule. They deferred it because of whatever reason. Their parents just said no, not now, but then they came back and they got it later. So we're talking about two groups of kids, both of whom had the same shots, just not at the same time. One got them very much earlier than the other. And there was a huge statistically significant signal between cognitive damage in the group that took it on the schedule. The CDC got that information and they deliberately destroyed the data set. Now, this was 20 years ago. I didn't know this had happened.
So here we have, Carl, a government agency that is really supposed to be advocating for the health of Americans, doing exactly the opposite.
Yeah, and the thing is that, one of the arguments that I have heard a lot of, and I've written an awful lot and spilled a lot of digital ink in all formats related to the COVID response and, those shots and some of the other things that the CDC recommended and that they didn't recommend, and, you're not a horse and, things like this. And one of the arguments that's been repeatedly raised by people on the other side of the debate is that, well, that was an emergency. We didn't really know what the blank was going on because it was a brand new virus. We didn't have a lot of knowledge. And so, you can always look at things in hindsight and say, well, that was stupid, but yeah, okay, we know that now. We didn't know it then. All right. That's a nice excuse. It doesn't work when you had a study 20 years ago and a shot that's been around for 40 years at that point, and it showed that following your recommendations in terms of timing was harmful. And rather than change the recommendations and say, hey, we kind of screwed this up. Okay. I mean, the shot's still maybe a good thing. However, not when we said you should get it originally. Wait 6 months. Instead of doing that, they destroyed the data set and it never came out in the public.
So, Carl, how do you see policy changing at the federal level as it relates to big pharma, as it relates to healthcare?
I honestly don't know. Part of the challenge here with all of this is that I don't know whether this will end up actually moving the needle. RFK is one man, and he's there during the rest of Trump's term. He most certainly will not be the CDC director when Trump leaves office. I think that's a foregone conclusion. Can you actually get institutional level reforms? Can you get the exemptions, for example, that are currently there for companies pulled back and removed? Can any of that sort of thing happen? Now, one thing that has occurred, and I have a suspicion that this information got to the Surgeon General in Florida, and that's why it happened. But I mean, this is just it's just a coincidence of timing rather than something that was actually said. Is that Florida is now looking to remove all vaccine mandates within the state. So they're going to kill all of the actual requirements. And that doesn't mean you won't be able to get them. It means that they won't be required by law. For example, to go to school. That is precisely what under this particular set of circumstances ought to happen. Because if you can't believe that the information that is in the government's hands is being used to set good policy, What other option other than letting people make their own decisions and do the research and then make a choice and get whatever consequences, good or bad, other than having it on them? What is the other choice you have?
Well, the clock says, Carl, we're going to have to leave it there. My guest today has been Mr. Karl Denninger. Check out his work at market-ticker.org. The website again, market-ticker.org. Karl, thanks for joining us today. Always enjoy your perspective and love to have you back down the road.
Anytime. Thank you.
We will return after these words. Hey, Dennis Tubbergen here. If you have not yet requested your complimentary copy of my best-selling Winning Strategies book, I'd like to invite you to do so. Just visit requestyourbook.com. Let me know where to mail it, and I'll be very glad to do so. The book will give you some sage advice about investing and asset management in the current economy. You'll learn about the Wealth Protection Trust and how to make your family potentially financially bulletproof. The book is also chock full of tax reduction strategies. It's yours for free. Just visit requestyourbook.com. Welcome back to RLA Radio. I'm Dennis Tubbergen. Hey, that's my show for today. Thanks for listening in. Be sure to tune in next week when my special guest will be Mr. Doug Casey of Casey Research. I'll talk to him about his latest book titled The Preparation, and I'll get his take on where stocks, bonds, and gold are also headed. That's next week on RLA Radio. Don't miss it.